There we go. Credit cycle. It's one of the things that I think everybody top of mind everywhere for obviously good reason. So when we were putting together URL University Live, talking with Chris and Vin Meter, of course, introduced me to Joe, and I thought this would be a perfect presentation. Because not only are we interested in identifying signals about a credit cycle, upside, downside, and various cycles within the downside, I wanted to give you all an opportunity to talk about or to listen to the opportunities that something like a downswing or a credit cycle would actually afford. It's great that we can talk about all these general ideas, but what do you do about it? In fact, that's I think the most common question I get certainly is, okay, that's great, but what do we actually do about it? So that's why I wanted to come here with Joe. Joe, you've been in the real estate business and credit business too for a very, very long time, long, extensive history, dealing with, various stages, especially in Florida, various stages of the real estate market. So when we're talking about a credit cycle, credit opportunities, there's various different parts of it, obviously. So, and I think Joe, with your unique experience and unique expertise, especially in real estate, that's probably a part of the marketplace that not a lot of people have even thought about. So that's what want to bring in Joe to talk about something that not a lot of people have really uncovered. And you have a unique way, unique methodology of looking at things and how you work out. So let's start. Joe Bettag, everybody.
Thanks, Jeff. So first of all, thanks for coming. And we're talking about real estate debt mostly. We have a lot of famous residents that live around here. One of them is Wayne Gretzky, who I consider the greatest hockey player that ever lived to play the game. And one of my favorite sayings they always would say is it's not where the puck is, it's where it's going. And we're going to talk about that as far as where the puck's going when it comes to real estate and real estate debt, as far as how people can make money in this space. Briefly, I'm going to do a quick background as far as what I've done in the past, and then we'll talk a little bit more about stuff, and you can fire away on some of the questions, Jeff, if you want. So I was a real estate broker out of Illinois in the 1980s. I moved to the Jupiter, Florida area, which is just north of here, in 1991 for better opportunities and the quality of life that this area offers. I had family in the area, and I happened to play some baseball down here in the 1970s, so I knew the area pretty well. I joined Ocwen, which was a New York listed company in 1997. They were based out of West Palm Beach, and they became the largest purchaser and servicer of distressed mortgage debt in the country. I was one of the top performing REO managers there, and I'll define what REO means in a minute. Based on scorecard performance, I managed the most difficult region of the country, which was the Northeast, New York, New Jersey, Pennsylvania. I learned more in 5 years than people can learn in a lifetime. I was very, very fortunate to have that opportunity. So after I left Ocwen, I was involved in the commercial and residential real estate brokerage as a broker associate for a local office in Jupiter. Started getting REO files, and REO stands for real estate owned, which basically means the foreclosure's been completed, the bank owns the property. That's a banking term, REO. So I started getting files about 2007 from a lot of my buddies who I used to work with at Ocwen that became managers at other subprime lenders throughout the country. Started as a one-man operation, and everything started blowing up. And by a year later, in 2008, I had 7 or 8 employees. I'm managing 100 to 150 REOs at a time. It was nuts. And I bought the company, the real estate company that I was at, and I've owned it ever since. So by 2012, the real estate market was bottoming out. And I always had the goal to copy the same business model that I learned at Ocwen. Bill Irby, who was the CEO of Ocwen, became one of the 100 richest guys in this country from that model. And so I created the first fund with 2 other partners in 2014. We closed out successfully in 2017. We achieved very high internal rates of return from that first fund. Then I created a second fund from 2022 to 24, even higher rates of return compared to the first fund. So now we're on our third fund. This one's a little bit different in the sense that I've got Chris, thank God, who's helping me to scale it with a broker-dealer network. And we have a very, very deep bench of very experienced team members that are over 100 years of experience in this space. As an example, one of the guys ran 8 NPL funds last cycle at $1.3 billion. NPL means non-performing loans. Just so you know what that abbreviation is.
Yeah, Joe, let's back up and do some basic here. Let's make sure everyone's on the same page.
Yeah.
Joe, we started with REO.
So REO, real estate owned, which I think I defined that. Hopefully everyone understands what that is as far as bank-owned properties.
And banks don't want to own the properties.
Right. And matter of fact, that's a good point. So what happens is with banks is once a loan becomes non-performing, the banking regulators require additional assets in their balance sheet to allocate for that future loan loss. So the banks will typically sell those non-performing loans at a significant discount to get them off their balance sheet because it impairs their earnings every quarter. So it's all about the incentives that the bank executives have to make as much money per quarter. So they're going to get rid of that bad debt to clean up their balance sheet. Matter of fact, Fannie Mae, a couple of quarters ago, allocated close to $1 billion of loan loss reserves.
And so this is where the opportunity really starts.
Yes.
This is where the process really starts. Our question over here.
I've read a little bit about REO in the past. So tell me if I'm wrong, Joe. That when I understand there's like a misperception of real estate laws when we think of foreclosure, right? Which, like you said, it has been foreclosed upon. But most people think of like foreclosure. I'm going to go down to the courthouse and the auction, but actually when that's going on, it can be quite competitive. It's not really, the REO is post foreclosure, and it's where the real opportunity lies, from what I understand. Is that part?
Well, it's once it goes REO, and I've sold a lot of them. It's more of a retail play. There's not much spread left. I mean, investors can still make money. Matter of fact, George Gammon did that in Kansas City last cycle. That was stuff. I was talking to Josh about that to confirm that, and I was going to bring that up. It's like, yeah, George made some good money, but what we're talking about by buying NPLs, he could have bought and made 25 to 40% more per property. That's the kind of discount that we're talking about.
So let's talk about it with NPL, what exactly you mean?
Yeah, NPL, non-performing loans, mortgages or loans where the owners have missed payments. That's basically it in a nutshell. Yeah, the banks have it, but normally once they're in default, they'll start peeling off and selling those loans to private equity, to other players.
And get rid of the things.
Yeah, because it affects their balance sheet and their earnings.
It gets to a point, right, Joe, where the calculus from the banking side of it is they have a rotten asset that they just need to get rid of because it's toxic waste that's just sitting there quarter after quarter after quarter.
Right.
So there's an incentive there to give them an out to make them want to move it off their balance sheet.
Exactly. Very well said. So a few other terms real quick I'll throw out to you, and this helps from a strategy standpoint. Deed in lieu. We try to do those as much as we can. Those are owners in foreclosure that agree to give up their interest in the property, and they'll sign over their interest to the bank. Stops the foreclosure, save the money on the attorney fees, you save the timeline. We always give incentives to the owners to sign a deed in lieu all day long. And we, part of the beauty of our model is how we try to manage the timelines, because the quicker you can turn over those assets and turn over that capital, is like in a 4-year fund, we'll do it 3 to 5 times in a 4-year cycle. The more rates of return, the higher you're
talking about the loans in the portfolio that you put together. You're always constantly churning through them.
Yeah, as fast as possible, because there's a time value of money that comes into play, and I learned that at Auckland. Another strategy is cash for keys. We do that a lot when the foreclosure is completed. Maybe the owner's in there, maybe there's a tenant in there, and what we'll do is we'll offer an incentive for them to vacate the property. It's like a contract, basically. And a lot of the banks who are locally that I'm doing business with will offer $3,500 for the typical middle class type of home, which is enough for their first month's deposit for them to move on with life. As compared to going through an embarrassing eviction, and it's not good for anybody. So it's a better fit for everybody involved. That works a lot.
What you're really talking about is lining up so many incentive structures that move into your favor. So it becomes an asymmetrical process. You're giving the bank an incentive to get out of the property. You're giving the tenants or the owner an incentive to vacate the property. So that everything lines up so that you can execute the strategy we're talking about.
Yeah, and again, it's timeline management. The faster you can execute on that, the higher the rates of return become. less friction, but also time value money. I keep saying that because I learned that Auckland it's baked in the cake. So here's another term, short sales. So that's when a homeowner owes more against the home than what it's worth. They're upside down. You hear that term a lot. So the banks will approve short sales where they understand if it goes to foreclosure, they'll lose more money between the carry costs, the eviction costs, the attorney fees. They're cutting their losses. They understand they're already in a losing position. They're just minimizing their losses. They agree to a short sale to get the owner out of that property and for somebody to buy it. So we'll employ that a lot as well when it's applicable. Loan modifications, we see a lot of that, especially since the last cycle. Mortgage loans that miss payments that go into default. A lot of the banks will work with the homeowners to work on a payment plan that they can afford. And in a lot of cases, we saw that with COVID, the COVID forbearance plans, and we'll talk about forbearance in a moment. But basically, there's a lot of different ways to do that. I'll just give you a couple examples. With FHA, you'll see a lot of loan modifications where it's a 30-year loan, they'll modify it to a 40-year loan to make the payments less, to try to make it something that's more affordable for the homeowners.
Or now a 50-year loan from the government.
That's what they're talking about, which is insane. 40 years is insane as far as I'm concerned. And what happens is
Modify every loan to 50 years.
but what happens in reality is even if you do a 40-year loan, insurance and taxes go up. And especially on what they're modifying. If they did a loan originally that at a lower interest rate, at today's rate, they had to modify that to the new rate on a 40-year loan. So between the higher interest rate and insurance and taxes, they're not really saving that much money. So you see a lot of those loan modifications fail.
Why does the insurance and taxes go?
Oh my goodness. Why?
Yeah, insurance makes sense. Are you saying the cumulative payments on them?
Yeah. When like Florida is a good example. We've had huge increases on property insurance costs, huge. Because of the hurricane damage and everything, and there's so much money the insurance companies have to make. Not just Florida, but other parts of the country as well. Then taxes. Depending on the state, you can have a homestead filed where you can limit those type of increases. But a lot of these people, particularly FHA type of buyers that are buying homes with 3% down, they don't have a lot of savings. It just takes one problem in their life, like a AC breaking down or a roof or whatever, they're in trouble financially.
No, I get that, but you said when you modify the loan, the insurance and taxes go up.
No, it's not because of modification. It's just life in general goes up. Yeah, and thanks for that clarification. Yeah. So that's just over time. That's what happens. But primarily it's the interest rate by itself, in today's world. Yeah.
So you're really talking about cost of living issues that, especially recently, that cost of living, lack of income growth, and the lines are crossing.
Right. Which you talk very eloquently about, and that's why I watch you every night. So in this business, it's called loan mods. If you hear that term, that's what loan modifications are. Loan loss reserves we talked about. There's a lot of the banks, Fannie Mae, they see what's coming. They're loading it up on their loan loss reserves. They see it coming. Mortgage forbearance, that was a good one. So after COVID, when the economy was shut down and a lot of people weren't working, a lot of people don't know this. This is kind of scary. So this is under the Biden administration. They on all the mortgage missed payments, they added it onto as a second mortgage, 0 interest rate, not recorded. It's a silent second mortgage.
How frequent was that?
Much more than you think. And the average balance was $80,000. So
average?
The average. So when you're seeing these articles, everyone's equity rich, everything's fine. They don't even know what the true equity position is, on these properties that were affected by the COVID forbearance plans. The only way you find out is when you have to order a loan payoff. That's the only way you find out. So
Question over here, Joe.
Are you familiar with the work of either Melody Wright or John Krasinski?
Matter of fact, two people I know very well. Melanie and I go back to 2022, and I want to talk about Melanie in a minute. And John is very good. And he was, and I'll talk about John in a minute too. Yeah, exactly. Right. Yeah. Yeah. And those are two people you need to follow if you have any interest in this space. Both of those can be found on X. Both of them can be found on Substack. And on Substack, you can get a lot more detail if you pay for it, but it's well worth it in my book as far as what they offer.
So just to be clear, let's go back to that point, because I think that's going to be huge, that there is a ton of hidden debt out there that nobody knows about. Nobody knows about that.
It's just hitting right now too.
The reason that nobody knows about it is because it's been able to be carried as a hidden variable for several years. But as all of these lines start to cross, it starts to become more of an issue.
Yep.
Which
That is, yes, as to what that is.
I don't think.
I don't know if they can quantify them because it's so hidden. I mean, how do you, no one's, you have to get a loan payoff for each one.
Yeah, Justin.
So for the second loan, if it's the liability of the borrower, whose balance sheet is it showing as an asset vol?
Well, that's a good accounting question. I'm not sure. I'm not sure how to answer that one. But I know it. But I know it's a payoff. It's on the payoff. It needs to be dealt with.
Got to be on a bank's balance sheet.
Yeah, I was saying so.
Someplace.
Yeah.
Or it's buried into private equity.
Yeah.
Or not private equity, private credit.
Yeah.
Sorry.
The administration ended this program, I think it's something like September, right now.
That was it.
6 months.
Yeah. Well, that was the FHA program, which we'll talk about in a minute on the loan mods, which was a lot of mortgage fraud involved with that, with investors too. We'll talk about that.
We can get away from it. So you can see where we're kind of going here. We're getting into these hidden variables that become opportunities. So
Right.
sorry, Joe.
Yeah, no worries. So, so the new subprime this cycle is FHA and VA. So, and we're seeing a lot of mortgage fraud involved with some of those loans as well. And I've seen it in real time, boots in the ground, right here locally, already in the last few years. A FHA owner-occupant mortgage, but it's not owner-occupant. It's actually an investor that's portraying himself as an owner-occupied to get a 3% down payment for leverage.
I think we've heard about a few of these recently.
And then rent them out.
Yeah.
And then, so that happens a lot. And also with VA's no money down. And I've got some files right now with a large.
Like I know we asked that before. Can you come up with sort of just a ballpark? In your own experience, how prevalent is it?
That's hard to say because by the time by the time I get the file, the property's vacant. And if I talk to the neighbors or if I get the feedback, I can kind of piece it together.
It's not easy to really.
It's not really, but it's the one thing I will tell you, and John Comiskey talks about this, is when the lenders sent out the first letter of, hey, you're behind on the mortgage, a lot of those letters come back, no one's there, no one's occupying the property. And you're usually, if you're in foreclosure as a homeowner, you're going to stick around as long as you can because you have an emotional attachment to that property. If you're an investor, you're out of there. So when you see, and it was like, I don't know, 20%, something like that, of letters that were going out where the homes are vacant right at the foreclosure. So those to me are probably more like investment properties, and they saw it was coming. That's why they just bailed. But here's some examples as far as what's going on with some of the values as far as decreasing. A couple of examples. Punta Gorda, it's on the west coast of Florida. 12.9% loss year over year on values. Austin, Texas, 8.2 loss in value in 24, 6% loss in 25. It's important to note each market down to a zip code. And here's a good example, Atlanta. Dallas has a lot of these same attributes. In Atlanta, if you look at the zip codes in the northern part tier of Atlanta and the suburbs, those values are generally flat to still going up a little bit. But to the southern part of the suburbs of Atlanta, the values are going down year over year, 6 to 13%. So you have to have that kind of granularity when you're looking at every market to understand where how to make money.
Do you have what's causing that stress? Is it just the cost of living and lack of ability to maintain?
Well, the correlation is a couple. The middle to lower middle class strata is being affected. And you've talked about that on one of your shows, where those are the ones that are struggling the most financially as far as cost of living. And those are the ones that tend to get laid off first. Whereas more of the college educated folks that are a little bit better about managing their money, they're not hurting as much. So it's the K-shaped recovery or K-shaped economy that you're talking about. The bottom 80%, they've got challenges. The top 20
kind of thing is you're seeing it around the edges and the margins first. The most vulnerable homeowners are those that are just starting, or are they kind of a little more developed?
We're in about the first or second inning.
Okay, so just starting to erode, and you're starting to see the signals show up.
Right.
Gotcha.
And so, and here locally is a good example. The canary in the coal mine for the nation's Florida.
Yeah.
And then the canary in the coal mine for this market is Port St. Lucie.
Always Port St. Lucie.
Port St. Lucie is infamous.
It's a poster child.
Yeah. So it's one of the top 5 millennial cities in the country as far as millennials commuting to West Palm to work. And you have just, so many homes, tract homes that were built. It's still being built. But those, the typical FHA buyer, 3% down, living paycheck to paycheck. And you got to remember, during COVID, during the run-up, you had people buying homes sight unseen. You had people waiving their inspections. They didn't even know what the hell they were buying. They didn't know they needed a new roof. They didn't know they needed new air conditioning. Or I've seen some cases in a development here, they didn't even know they were next to a hospital or next to a highway. They were buying a video based in New York, never seeing the property. So all these things are kind of coming together now. Like Port St. Lucie is a good example. 2 years ago, the average tract home was in the low 400s. Now, low 300s. There's a corridor on Military Trail between 45th and Okeechobee that are townhomes, like quads, the 2-story quads. 2 years ago, 18 months ago, they were trading for low 300s. Now you can pick them up for low 200s. So just think about the number of homeowners that actually bought during this mania, from 22, 23, 24, and even 25. They're upside down.
Yeah, that's the common narrative, right? It's the idea that, prices are softening. However, most people aren't upside down because the price appreciation, they're just losing some of their equity.
Yeah, if they bought pre-COVID, but if they bought post-COVID and a low down payment, they're already in trouble. So here's a couple other numbers that are kind of surprising. FHA mortgage defaults. Last week, nationally, they went from 12% defaults to 14% defaults. And the ones that are seriously delinquent, which are defined as 120 plus days in default, 6% of all FHA loans are already there.
What does that compare to 2008, 2009?
Well, it wasn't FHA back then. It was the subprime was more conventionals where it was
private label.
Yeah, there was private label. It was like if you have a heartbeat, you can get a loan. No income verification.
But that's really the point, though, because now we're talking about FHA loans that are supposed to be verified and go.
The problem is I'll finish this thing. Go ahead. How they're qualifying FHA buyers, you can go up to 50% of debt to income, your total debt, based on gross income. To me, you're setting somebody up to fail. I'm sorry.
It's kind of the objective.
I think so. The way
always speaking the simple truth here.
Quick question on rate of defaults. They were 12% last month, 14% now. What's the baseline?
Total FHA loans. But it's going up.
It is the historical default rate.
I don't know. I mean,
I think it fluctuates.
I only pay attention when when I see the red flags, when I can start making money. Yeah.
It's a lot more than you think it should be.
And here's another thing. Now let's talk about the college loans that are due with the SAVE repayment plan. So that's coming up pretty soon. And John Kaminsky talks about that very much. But he just came out with a really good article on that here recently. And he's projecting that it's going to be starting in June. And these are people, again, are struggling already financially, and this is going to be another payment that they're going to struggle with. So someone's going to have to give. But he's projecting that between 500,000 to 1 million FHA borrowers will be significantly affected by those payment plans. So you're probably talking about even higher default rates as a result of that. Let's talk about commercial real estate. So I know your buddy that buys apartments. What's the gentleman's name? I forget.
You're talking about Ken McElroy?
Yeah, Ken.
Yeah.
Yeah. I have a lot of respect for Ken, by the way.
Sure.
So, but there's a lot of extend and pretend going on right now in commercial real estate.
He's like, it's more than you think.
Yes, much more. And I'll give you a couple examples.
That seems to be the common theme here, right?
Oh my God.
There's so much, the ability of banks, financial firms, governments with a wink and a nod to essentially bury so many of these problems.
Yep.
But they can't keep them buried forever.
Right. So another good guy to follow on LinkedIn is Bill Moreland. Bill Moreland is a banking analyst that I've known for some time. He's based out of Ohio, and he's got some really, really good numbers. And the one thing that he really pointed out that started a couple of years ago was the banks. It used to be like if a borrower got in trouble and they were put on a loan modification program, that loan then was defined as a troubled loan. Even if they got back on their feet and started making the payments, that was still in that troubled loan bucket. Now, after that trial period, after 6 months of payments, it's a performing loan with no red flags.
So they count it as totally cured?
Yes. And Bill's going nuts over this. And so he's got some really good details on that.
That is relevant to
Yeah.
loan.
And by the way, I had a conference call Thursday with some of the top default professionals in the country. And it was with one of the largest REO short sale platforms that's out there that we use. And there was an acknowledgement that a lot of the banks are in trouble right now because they don't know how to handle all the short sales. They're not set up. A lot of the decision makers are in their 40s. They weren't around for the last cycle. They don't know how to be prepared for it. So there's a big problem right now with the banks even figuring out how to conduct short sales on a massive basis right now.
It's also different years. So the bankers that were around for the distress of short sales were in the residential space, weren't in the commercial space.
Right. Yeah. But man, you're seeing commercial as well. But I'm talking about I'm mostly in the resi when I make that statement.
So you're saying there's a uptick in volume for short sale residential?
Huge. And the banks aren't set up to handle it. They're not set up. So
They do have loss mitigation procedures that are very different than they did going to.
They do, but they don't have the personnel in place. And I can give you personal experience what I'm dealing with right now, and I can't really name the institution, but they don't have the attorneys and the decision makers to deal with title issues for resolutions of REOs. So they're sitting there in like a zombie state for months and months and months.
Oh, sorry, you said title issues?
Title issues.
Real quick, excuse you. I don't want to go so far as to say this is being presented as a bull case, but I've heard, just play devil's advocate briefly as I've referred, maybe this is what you're speaking to, Mike, is about the banks having been, it's funny you're saying now you have even more experienced people, but in 2008, banks had never been through anything like that before, and they panicked. And this time, some of what they're doing here is actually more intelligent because they're preventing the fire sale. What would you say to somebody that say, "Oh, the banks have a better handle on this time"? Well, they're preventing the fire sale.
They're doing a lot more loan modifications and loss mitigation than they did last cycle. I mean, we were involved on our first fund in some cases where we were big believers in loan modifications, and we tried to do that because we bought at enough of a discount where we could still make money on how we did things. But we literally had borrowers that we would talk to, and our asset managers, they would be crying because they could never get a hold of anybody at a bank to even give them the time of day to figure out how they can work with the bank to get this done. So in that regard, the bank has learned a lesson where they've got at least more of an infrastructure in place, but it's not yet where it really needs to be, just given how quickly things are starting to move south as far as the defaults.
They have the awareness of what we did wrong the last time.
Right.
However, they're not prepared for the scale of what might be coming toward them.
Yep.
And so the possibility is they could be very quickly overwhelmed.
Well said.
Seemed like last time they were more eager to take them on. Like I said, banks still want to loan these properties, but they all went and did exactly that the first time.
Well,
they cannot to own them.
Right.
What they're doing is essentially just, hey, we'll try to.
Well, first time the idea was just foreclose and sell. Just get the hell out of it. They realize they can't do that. But what Joe is saying is that this is a little bit of a different animal. that they realize that you don't want to foreclose and sell, but how do we deal with? Oh, we can handle one or two more, a couple of distress problems, but when you get to the potential for scale that Joe's talking about, then it becomes. Then you get into uncomfortable questions. I think that's really the issue.
Yeah,
right?
and matter of fact, this is kind of relevant. I'm kind of skipping through what I had on my notes, but I had dinner about 6 months ago with two of the top 5 loan servicers in this country that I used to work with, and very interesting discussion that night where they basically said that the mortgage investors all they care about is squeezing much interest income as they can. And even if they have multiple loan modifications and they have to keep adding on the missed payments onto the principal balance, as long as they keep seeing interest earnings from that loan, they're going to keep doing that. And I said, well, that's not sustainable. At some point, if things change, what's going to happen? Is if unemployment goes up and values start flattening out or going south, yeah, because they don't want those loans to go to foreclosure, because if there's any equity left in that property, a third party is probably going to take that equity to outbid the bank at the foreclosure sale. So they're going to milk those loans as much as they can. But all that starts changing, though, between the unemployment rate and the direction of values. And we're starting to see that about 50% of the country right now. The Southeast, Florida, Texas, the mountain states.
You're also seeing the unemployment rate spike in a lot more counties and locations than the national unemployment rate is somewhat misleading, not entirely, but somewhat misleading. There's a high degree of variation. And I would imagine, you probably know this better than I do, that there's a pretty strong correlation there.
Right.
Where you see counties with higher unemployment rate. We're already seeing that in delinquencies. That Federal Reserve Bank of New York, earlier this week in their quarterly household credit survey, they actually made a specific survey of the correlation between rising unemployment rate in specific counties and delinquencies and mortgages, which by overall mortgage delinquencies are low, but they are starting to creep up, and they're creeping up in exactly the way that Joe's talking about. So what you're saying has already been validated by the New York Fed too.
Well, they got something right.
Look, the Fed, as far as information goes, they're very good about getting information. They have no idea what to do once they get the
Especially when they have a governor that completes mortgage fraud, but yeah, that's a different story anyway. So
we can go in a lot of different directions.
So anyway, for us to make money, we got to be at
Let's talk about your strategy.
Yeah. So how we make money?
Where's the opportunity?
Okay. So we have to buy the non-performing loans at about 50 to 70% of the collateral value, the real estate that secures those mortgages. We're there.
What do you use collateral value? What are you using for collateral value?
Collateral value is the real estate that secures the mortgage.
No, but I mean, what's the value?
Yeah, so that's one of the key to how we manage risk. You have to know your values. You have to know that they're reliable values. So we have a boots on the ground network of the top default professionals in this country that I'm in a leadership role with that help us to manage that process. And I'll have those guys and ladies, for that matter, help us determine that value, that we'll validate it in a number of different ways. That's one of the most important parts in terms of getting it right. But also when they're out there determining that value, they're already giving us an idea if it's vacant, if it's occupied, if it's a tenant, if it's an owner. That's already telling us on those variables from a due diligence standpoint, which one of those paths we're going to be going to be making.
Starting out with you're starting out with an informational advantage, right?
Yes.
You're getting non-market information that nobody else has.
Right. Yep. So and there's a sequence. As a matter of fact, I've talked to Melanie about this. Her and I consider her a friend. We started talking in 2022. Matter of fact, as a side note, she was at GMAC in Dallas when I was getting 15 to 20 files a month from those guys. And so she's been through a cycle. She understands what to look for, but it's based on data, not opinion. So based on data, there's always a sequence of events that tend to happen. Now, we haven't seen the black swan as far as Lehman blowing up, but you still see that sequence. And it tends to be, first you have the bubble. Then you've got listing inventory that has to build as far as more supply. Then the market stalls and starts freezing out, which we're seeing a lot of right now as far as buyers not willing to pay for what the sellers are asking. And then unemployment starts to increase. Sellers begin to go from motivated to desperate, depending on their individual circumstances. And then the foreclosures are next. We're kind of going in that direction right now. So those are some of the things that we talked about that I've confirmed, as far as the cycles over the years. Right now, 50% of the country is basically in trouble.
Yeah.
Okay, 50%. A year ago, it was only Texas and Florida, but it's spread now.
Yeah, you always got to keep in mind with an economy or the real estate market or whatever it is that you look at the homogenized national numbers and sometimes they just don't tell you enough information because there's lots of regional variations.
Can I just have one brief question, because I'm not as north in real estate. The number that you look at in aggregate for NPLs, how does that correlate to, in other words, increases in NPLs lead to increases in REO, right? Is there a break point? Are there statistical or numerical changes in the NPL that in a fixed way precede an increase in REO?
There's a direct correlation, but I don't know how to quantify that in terms of.
Well, that would be a non-continuous process. I would think it would be more of a linear thing where you start to see the NPLs creep up and then.
And then you would see the REOs go.
Yeah.
Somehow, is it consistent? Or is it just kind of random? I don't know. I'm just asking.
I'm not sure I understand the question in terms of
How does the non-performing losses lead to increasing REOs in cases and their relation? Can you tell from the MPLs how much is that going to feed into the downstream?
Well, I mean, that's the example I gave earlier about FHA is a good example. So we've got right now, and there's different timelines. So overall you've got a 14% FHA default rate. But then you've got, that's 14% that are 30 days or less. Then you've got maybe, 8% that's 30 to 60 days late. Then you've got, the 6% that's 120 days or late. Well, that's 6%, that's a problem. That's where the problem is. It's not the 14%, it's the 6%.
But the point of this question is if the 14% becomes 20%, the 6% goes to maybe not 10 or 12.
But that's the correlation. The higher that default rate goes up on the front end, eventually the back end starts going up as well. That's the correlation.
Yeah.
It's a funnel, yeah.
But can you there's always a fair amount of curing that goes on.
Part of this point is that they've actually taken a record number of people out of NPLs. Yeah. That's the refinance round.
Well, so that's the other thing, right, Joe? Is there's a hidden variable in all this that we don't really have a quantification on.
Well, but
so yeah, we can.
I'm going to come back to the point though that was raised earlier. That John Comiskey, by the way, God bless his soul, raised first back in the summer of this year. The amount of mortgage fraud with FHA loan modifications. It was huge. There was roughly 150,000 loans that were defaulting, not making one payment, and then they would just basically just keep kicking the can down the road, increasing the back end of that mortgage balance, and people were living in houses for free, not making one payment.
Basically, FHA was in on it.
Right.
We're going to let you do this.
Right.
I mean, mortgage brokers sold by 10.
Right.
That's the pendulum that swung for our housing crisis. The later housing crisis was we need a full government to bank and everybody in between effort to hide everything.
So October 1st, anyway, between John and then Melanie got involved, and then a few others. It was a firestorm on Twitter, and then finally Scott Turner, the head of HUD, saw it, and those policy changes were made effective October 1st. That's part of the reason why we're seeing higher FHA default rates, because a lot of that was being hidden with these loan mods now are being flushed out.
Like Daniel DiMartino Booth.
Yes.
Wrote a letter to open letter.
Yes, she was the other one I couldn't remember on the name, but she has a very big following. So that was good, and that's why you're going to see now more of what was hidden, so to speak.
The other thing, just very good that I highlight at this point, I mean, it wasn't just mortgages and student loans, etc. I mean, I feel like you look in the narrative of COVID. It was that government stimulus drove this huge increase in savings. Suddenly, everybody had tons of money, etc. You can't match it up. at all. It's a 6% increase in GDP. There's no possible way it translated to a 35% savings rate. What happened is literally people stopped paying their student loans. They stopped paying their mortgages. They stopped having to commute to work, et cetera, et cetera. We have seen those savings degrade over time. It means everybody's spending in aggregate significantly more, or at least people at that end, were spending significantly more than they were making in income, and now we're just hitting the wall.
Right.
That's the line crossing.
Actually, with that, kind of as a recovery short seller, the first thing that comes to mind is that the government's going to come and do this again. Because all this will be wiped out.
Well, keep in mind, if the Federal Reserve's balance sheet is an issue, and that's how it happened last time by buying a lot of the MBS. I don't think they're on record, especially now with the new Fed chief coming in. He's made it very clear, Kevin Walsh, that they're not going to do that.
So you're not factoring in any kind of government intervention.
Well, what's the threshold and the trigger for it too? The idea is that, in 2020, the trigger for major government intervention was very low. And as we continue to move further and further away, and everybody's convinced that there is no problem, the trigger goes up and up and up. So eventually it gets to a point where everybody thinks this is normal. The government doesn't step in until after something breaks. Not beforehand. The government's not proactive. I'm just saying this. Joe, you probably agree with me that it's not that it's not a possibility, because
You factor that into your fund, but at some point this is going to change because the government's going to do this.
We could say we can still make money because government's never the solution. They tend to make more problems than they tried. I mean, look what happened with COVID. Look at the cost of living and inflation that result of government intervention on monetary and fiscal policy. You call that a solution? No. There you go.
On the business, I would actually just emphasize that, like, what you're actually doing is you're positioning ahead of thought.
Yeah.
Right. So when the bailout comes, the bailout's not going to come because 2 people default, because hundreds of
2 million people default.
defaulting. Yeah. You then need to bail everybody out. Guess what you want in the paper?
And that was the great.
Which gets us back to the opportunity here, right? Is what we're really talking about. You are seeing this information for the first time and understanding implications has led to a market dislocation.
That's
which
correct.
you're anticipating will correct in your favor.
Yes, over time.
Over time.
Over time. Right. That's a great thing about real estate.
Simplifying.
Yeah, that's a great thing about real estate. It's a slow-moving index. It's not like the stock market where you get your head handed to you like in a week or two. It's as long as you know how to position yourself ahead of it, even if there is some government policy changes, it doesn't affect the market overnight. It's a very slow-moving index. And the other thing I always try to keep in mind when I'm analyzing markets is mean reversion on values back to trend. And that tells you a lot about where each market is. But speaking of which, I've got a neat little tool here. So, do we have time for this? Oh, absolutely. Okay. So, I know we got some people from Texas. This won't work for the gentleman from Australia. But let's name some zip codes for out-of-towners here. Who
Shout them out.
Any zip codes? I'm sorry?
76502.
76502.
Okay, let's look at that. What was it?
76502.
502. Okay, so Temple, Texas. So in Temple, values in the last year have gone down 2.1%.
Is that Houston area?
Bell County? By Waco?
Yeah.
Right.
Oh, no.
We're at south of Dallas. So let's look at Dallas. This is a good one. That's close by. So that's gone down 3.8% year over year. But here's the other thing that you have to keep in mind is in a lot of markets, especially around here, this is the scary part, in my opinion. The average gross income to support the average price with today's interest rates, 40 to 50 to 60% of your gross income to support the average price in this market right here.
Which is not sustainable.
It's not saying it should be 30%. So Texas is one of the more affordable markets where those values are more in line. But we've seen it Austin, Texas is a good example where it's really been hurting. But I have the technology where I can look at any market instantly, look at what's been going on, what the important dynamics and information is to make a decision about those properties in a portfolio acquisition. So it's all about analytics and information as far as how you have to analyze a market.
Joe, let's talk about okay, so you've got an information advantage. You sense the market dislocation. You think things are lining up favorably. What do you do about it? How do you put together a fund, and what is it you're trying to really accomplish with the fund?
Well,
And is it a crowded space and there are a lot of people interested in?
Do you take them out of the advanced cycle, traditional,
I'm sorry.
7 to 8 life cycle, the return on capital is
One more time. I'm sorry.
True real estate deal where they return money to buy it back out 7 to 8 years of that.
Well, no. The funds are 4-year funds. The investors that have option. The first investors are what I have the most loyalty will have first option on the next fund to go in before I go back to go back to anybody else. But it's a 4-year life. And generally, what happens is here's some good numbers. The first fund, our average holding period per loan was 295 days. Our second fund was 179 days. So we can turn over that capital 3 to 5 times in a 4-year period. That's how we get these kind of higher internal rates of return. So the way the fund is structured is we're turning over
Leading into a market that's heading in your favor.
right. So we're turning over that capital the first 3 years, and then that third year we're winding down the fund from the third to the 4th year. Investors get their preferred interest back, their principal back, and then we split on the back end as far as a waterfall.
You might just answer my question. You're flicking these MPLs. Essentially, you're not. Are you taking over the property, managing the property, putting a tenant in there, and renting?
No, we're not in this time of the cycle. Are we looking at for long-term holds like that because there's too much risk, because you're catching a falling knife in a lot of markets. So our strategy
Now, right, Joe?
yeah, our strategy right now is to turn over that capital as fast as possible, right? Mom and pop investors, we have a huge database.
Sorry, for
For the MPLs, there's enough mom and pop investors out there that understand this space, where they understand they can make a lot more money buying an MPL than buying an REO. So their discount, what we can make a spread. There's meat left on the bone. They complete the foreclosure. Their cost base is a lot less than what it would have been as an REO.
So you're kind of sticking yourself in the middle of the process, right? You have the market dislocation. You're leveraging your information asymmetry to create that spread in the middle.
Right.
And then you have, at the end of it, you have waiting buyers that you are, relatively sure that you can depend upon to get yourself out of this.
Right.
So it's a soup to nuts kind of a process where identify the location, understand the information, make sure you got all your I's dotted and T's crossed, like you said, because that's a major pitfall.
Yep.
And then in the last part of it, which is one of the biggest part of it, is you're not sitting around holding these properties. Your intention is to sell them to somebody else who you already know is waiting for.
Exactly.
Got
And there'll be, like early in this cycle, we'll buy REOs, where as long as there's enough of a discount and we could turn over that capital pretty fast, because we're already past the foreclosure. A lot of the money I made in 22 to 24 on that second fund were REOs.
Is that passive income through a D1? What is that?
That's how it's set up. Yeah, that's how. Chris, I don't know if you want to opine on that as far as how we have it structured.
Yeah, bring the tax guy in.
Yeah.
Oh, what was the question?
Go ahead.
One.
Is that passive income? What would that be?
It's passes. Yeah. And the fund will pay any taxes. Of course, it'll cover any taxes that because it turn the assets in the portfolio, so it covers the investor's tax along the way.
Cool.
If you should turn 2 or 3 times inside of the life of the fund.
If not more. Yeah. So a couple other people to follow. I mentioned a few others. I just want to, Melanie Wright.
There may be a fund structure that doesn't have tax application to investors that'll look more like a preferred stock. So we're exploring that. That's more for asset managers, wealth managers who don't want to deal with tax pass-throughs, or Schwab, Fidelity that just can't even accommodate that kind of product. But for private parties, family offices, it's a parch.
No, people to follow. Melanie Wright, X on Substack and YouTube. John Comiskey, X and Substack. Bill Moreland, I mentioned LinkedIn. Rebel Cole on LinkedIn. Rebel is a head of the master's program at a local college here at FAU in Boca. He knows his stuff as far as commercial real estate and what's going on behind the scenes. Another good guy to follow. So,
Any more questions from anybody? George.
Just how would you measure, like, what kind of market situation might get to the point where things are moving deflationary so fast that the whole thing kind of collapses? Because it depends on things kind of going down slow, right? Not going down really.
well, I mean, there's always a potential of a black swan event like Lehman, which is what we saw in 2008. And it's all right that you said that, because one of our team members that I mentioned earlier, that managed $1.3 billion on the 8 funds, and I looked at his fund performance. He made the most money, and it was a 99% internal rate of return on his very first fund in 2009 when it did hit the fan. So what that does in reaction is the banks see that they're going to discount even more to get it off their books.
Yeah, you're taking advantage of desperation.
Yeah, exactly.
They've already done the program in my house.
Yeah.
I mean, it's a 3 years bond, right? It didn't bond until 2012 or there, right?
Yeah, well,
2010, 2020.
yeah, the historical bottoming out process is 3.5 to 5 years. So
And that's kind of what you're counting on too, right?
Yeah,
It was a long runway.
yeah,
It's not
right. But you got to remember that it's literally a 10 to 12 year window, because it takes that long for the market to recover. It might bottom out, and depending on which zip code you're talking about, the market peak was either 22 to 24, depending on the zip code you're talking about nationally. So then again, plug in 3.5 to 5 years, gives you an idea as far as the bottoming out process.
Yeah, because even on the early upswing, you're still generating NPLs, stress sales, and everything else.
Yeah, we were seeing opportunities up to 2017 for the last cycle.
Yeah, that's amazing.
Yeah, so it was what?
Yeah.
8, 9, 10 years.
All right, why don't we take a break here? If nobody has any more questions, then we'll come back for one little afternoon session. We'll get Mike and Brent involved and go from there. Thank you, Joe. Really appreciate the presentation. Thank you, Chris, as well. Terrific.